It is 3 p.m. live from our studio in New York City. I'm Julie Hyman. That is Josh Lipton. This is Yahoo Finance Live. And here's what we're watching this afternoon. The Fed-fueled rally on Wall Street losing some steam. We're an hour away from the closing bell on Wall Street, and stocks are pulling back from earlier highs. The Dow is still on track for a record close, and we're going to bring you the biggest movers and trending tickers.
Plus, the chip wars heating up. Intel, the latest company, unveiling its newest chip to better compete with AMD and NVIDIA. We're going to hear from Intel CEO Pat Gelsinger straight ahead.
And more relief for home buyers. Mortgage rates are falling again. The 30-year fixed rate mortgage below 7%. And with the recent moves in Treasury yields, we're likely to see further declines ahead. All right, let's take a look at the market action here. It has been an interesting couple of days with the big rally, really an everything rally that we saw in yesterday's session. Risk on, now transferred to something a little more tentative today, which tends to happen on day two when people take a step back and look at what the Fed has actually said. Maybe Jay Powell wasn't quite so clear as the markets would have us believe. After all, we are seeing markets price in even more rate cuts than the Fed's dot plot would indicate of 325 basis point cuts next year. We are still watching potentially for a record high on the Nasdaq 100, and any increase, Josh, in the Dow would be another record close today.
Yeah, it's interesting because when we were listening to Fed Chief Jay Powell yesterday, it's not as though he said, Julie, that he kind of declared victory. He didn't say mission accomplished. What he said was, clearly the tone was, I like where things are headed.
Yes.
The economy's slowing. Of course, that was the point. It's cooling, not crashing. Didn't see signs of a recession right now. Inflation, his comments were sort of like, listen, again, I like where it's headed. The trajectory, I like where it's going. He also said, though, we got a ways to go, right? We're not there yet. And he emphasized, we're not going to stop till we want to see that target. It's got to come back to the 2%. At least initially, when markets were listening to his presser, though, clearly what they took away was, Jay, you are done. You're done, Jay. We know you're done. You're done. Cuts are on the way. And we can debate, the timing of that and the magnitude, but that's how it is. And so you saw this euphoria take hold initially, stocks rallying, bonds rallying. You look at the yield on the 10-year back to 3.93 here.
We were trying to sort of push back against some of the guests yesterday that were feeling awesome. And they weren't having it. They were like, remember, Ed Denny just said, let's enjoy this moment, right?
Which was terrific life advice from Dr. Ed.
Sure. Yeah. But as always, to your point, there is a gap between what Powell says and what the market hears. It feels like when I'm talking to my kids, there's a gap between what I say and what they hear from me.
It's very good questions you're raising, because now, today, you take a deep breath and you think, okay, well, this optimism you're seeing, do you think it carries into year-end in 2024? But also bigger questions, did the markets did they get over their skis here a little bit, right?
We are seeing the relative strength index for the S&P 500 indicate we were maybe getting a little bit overbought. But at the same time, you've got a huge surge in semiconductors. We're going to talk more about that in a moment. Goldman Sachs at a 52-week high. The Russell 2000 of small caps is still flying today. Oil is up a lot. So you're still seeing signs of that happening.
All right, moving on here. Intel today accelerating its AI chip game with a focus on incorporating the tech into PCs and laptops. Comes as the semiconductor index rising to a record high earlier in the session, topping its 2021 peak. Intel saying the launch today is part of the company's largest architectural shift in 40 years. And CEO Pat Gelsinger joins us now live from the Nasdaq, along with Yahoo Finance's very own executive editor, Brian Sozzi. Brian.
All right, thanks so much, Josh. Pat, good to see you. I was in that room, packed house over at the Nasdaq when you unveiled these new products, Pat, and you started off your keynote in front of really that packed house, noting this is the dawn of a new era in tech. For investors in Intel, what does that exactly mean?
Well, we announced two critical new products today. One was our next generation Xeon server, where we're building AI right into Xeon so that every data center can use it. But the other was, what we were just commenting on, was the AI PC. And I described it like this Centrino moment where we first brought Wi-Fi into popular delivery, and every coffee shop, hotel, and business had to add hotspots and Wi-Fi capabilities. Well, we think of the AI PC PC like that kind of transformational moment where new applications, new use cases just usher in a new period of the AI PC. And with that, we're quite excited today to introduce our Core Ultra product line. That's the first one delivering this at scale, and we have a rich pipeline of products coming next year and the year after to really enable AI everywhere, and that's what our announcement was about today, bringing it not just at high-end training and ChatGPT, but every use case across edge, across client, across data center and cloud.
What industry do you think will be most impacted by some of the technology that you uncorked today?
Well, I do think that enterprises are just going to find a lot of critical use cases for this. We showed a couple today, in some of the communications technologies. Imagine real-time translation, transcription, summarization, contextualization. Wow, this is cool. But also cases like manufacturing lines, and we showed even our manufacturing line where high-resolution imaging and being able to detect machine variations and being able to improve line yields in our big factories. Wow, 1 day of improvement, and I paid for every PC upgrade I would ever do. So all of these use cases I think are important, but consumers as well. Content creators are going to find these to be much more productive ways. And we had a musician here showing off a project that would have taken her weeks now was getting done in a single day because of these new generative capabilities. So much like the Centrino moment, AI PC is for everyone. It's a new generation of PCs, and we're just getting started. We had 100 application vendors here with us today, and we expect hundreds more are going to find exciting use cases that we haven't even yet imagined for the AI PC.
Yeah, Pat, I think that singer walked out with the first AI PC. I was a little jealous, but that was pretty cool.
I was jealous too. I was like, hey, I'm the boss.
Oh, come on, you run the company, Pat.
Okay.
You should be able to get a couple of those for the family. But look, let's take us through, what is the outlook for these AI PCs? How many will you sell next year, and when do you start making them?
Yeah, well, we are already in volume production. And hey, I'm probably going down to B&H just down the street here from the Nasdaq and pick one up on my way out of town before I leave. So they are on shelves right now. We're expecting to see good pickup as people finish their Christmas shopping this year. But we're going to be volume. We're ramping this thing like crazy. It's going to be tens of millions next year. We said in the next 2 years it'll be over 100 million AI PCs in the marketplace. We have our next generation products are already sampling to customers. So today's Core Ultra is the starting gun. Application vendors, new form factors, new PCs starting to emerge, but we're just getting started. The next 2 years are going to be thrilling, going to be in volume, and we are delivering this at scale, enabling the software industry and making sure it's end to end, from the data center and cloud to the client and the edge, AI everywhere.
What are some of your biggest fears around AI?
Well, one of the things, and I commented on this in my keynote, that some people are a little bit concerned, it's sort of like artificial intelligence over there. What's it going to do to me? And I suggested that we might reframe it as augmented intelligence, where we're making it part of how we live, how we work. One of the things is, hey, I wear hearing aids, a family defect, and I now have neural enhanced hearing aids. It's not over there. This is part of improving my life and experiences. When it's in my PC, it is making me more productive on a daily basis. And we think part of our job as a company, we believe in this power of technology as a force for good, that we're going to shape technology. All technology is neutral, neither good nor bad. It's how do we shape it for good? How do we make sure it's regulated, it's safe, it's secure, it's trusted, right? All of those things are what we do, and that's how we're going to make AI useful for every customer on Earth.
Pat, I was just on the Yahoo Finance platform. Your stock's near a 52-week high, up 70% year to date. We have markets at records here. I'm not going to sit here and ask you to predict Dow 40,000. I know that's not your gig, but what do you think about these markets rallying? And from your standpoint, is your company doing so well that, and your industry for that matter, to justify where stocks are right now?
Well, I do think, as we talked about, AI is a driving workload. And that workload, we've said, the semiconductor market, 600 billion or so today, $1 trillion plus by the end of the decade, and we see AI as one of those things driving a larger market. Further, right, as leading edge technologies, these are the things that we uniquely do. Only a couple of companies in the world can do this, and only one in the Western world, and that's Intel. So with that, we see a lot of market value creation yet in front of us. We're still well undervalued compared to many peers, even as we made good progress this year. So I see a lot of opportunities for us to create value for our customers, to create value for our shareholders. And with that, we're pretty thrilled by today's announcement, because it really just is the beginning point of a lot of great things that we're doing, and what I believe will be one of the greatest turnaround stories in business history and technology industry history, the rebuilding of the iconic Intel.
Last week, Pat, I had some time to catch up with one of your competitors, Dr. Lisa Su, over at AMD. They released their new chip. You're out here with new chips today. Should investors be comparing your two companies?
Well, in some ways, of course. We're traditionally in this market together, but in other ways, very different. Right, and our IDM 2.0 strategy is a crucial piece of why different. We manufacture chips at scale. We manufacture our chips, but increasingly, as you know, Sazi, we're becoming a manufacturer for everybody's chips as well. And then you have the fabless model, and that's companies like Qualcomm, NVIDIA, AMD, and I have many products that I build as well. So essentially, I'm building two companies inside of one, a major foundry manufacturer at scale and a fabless company. So in some ways I compete, but in other ways, hey, I want to manufacture all of NVIDIA's chips, all of AMD's chips, as well as all of Intel's chips going forward. And we are rebuilding the world's supply chains for the most important resource of the future. Remember, everything is going digital. Everything digital runs on semiconductors. We allowed this industry to move from Western shores. We want to rebuild it back. The world needs balanced, resilient supply chains. That's what we're off to do. That's why we help drive the US CHIPS Act. That's why we're building these major manufacturing footprints. And that's why the total AI market's available to us, both our products and for our manufacturing.
Well, good luck at the rest of the event. It's been fun to follow that turnaround story at Intel. Happy holidays to you and yours. Intel CEO Pat Gelsinger. We'll talk to you soon. Josh, back to you.
Hey, thank you so much, Sazi. Always a pleasure.
Appreciate it.
Brian, thanks so much. That was great. Appreciate it. Now let's look at some trending tickers here. Shares of Disney, they're edging higher in today's trade here, about 1%. It says Trian Fund Management announcing plans to nominate founder Nelson Peltz and former Disney CFO Jay Rasulo to the media giants board. So this is a great story, Julie. So basically the news here is that activist investor Nelson Peltz plans to nominate himself. That's really the board. And this is interesting, the part where they're also nominating Jay Rasulo, who was, of course, the former Disney CFO. So this is a guy who obviously has very deep knowledge, background, insight into the company. He is talking tough, by the way. He's saying the Disney I know and love has lost its way. Lots of questions here, obviously. One is Peltz actually going to be successful here, pull this off? And in addition, what is Mr. Peltz's plan here? What's his strategy exactly? Because Bob Iger could say, of course, listen, Nelson, I have been working here. I have been making moves. I've been cost cutting. I've been adding, listen, we've been adding power hitters to the board. Recently announced, Morgan Stanley's chief James Gorman's joining its board of directors. We'll see how it shakes out.
We'll see how it shakes out. I mean, and the stock has recovered a little bit as of late, although
it's about 8% this year.
You could argue, it's up 8% this year, but it's really bounced like in the month of November specifically. You could argue that's because of Peltz's involvement and not necessarily because of anything Iger himself is doing. So we'll see how that works out. But as you and I have talked about before, there does seem to be, it feels like there's a personal element to all of this, that it's not just Peltz's playbook of coming in and really looking in a ruthless or passionless way at the numbers. When you have Rasulo making those kinds of comments, he left the company after essentially he was passed over for a promotion. You have to wonder what else is at play here.
Yeah, I mean, Iger had, listen, we talk about this company because it's so fascinating, the future of it. Iger has already listen, these issues get streaming to profitability, of course, the linear TV challenges we talk a lot about. So he has a lot on his plate already, and now he's got Nelson Peltz too.
Yes, he does. Let's talk about General Motors as well. The shares are trading. Let's see how they're trading right now. They're up about 6.5% as it announces layoffs in its autonomous vehicle unit Cruise amid a spending pullback on driverless cars. But it's not just a spending pullback on driverless cars. This company, this unit has had some specific issues, most notably one of its driverless taxis dragging someone recently, and so they had to make some changes linked to that. And
regulators stepped in a lot more heat. Yep.
So there's the demand issue of there's just bigger questions about autonomy. And we're coming, this news coming a day after there was a 2 million vehicle recall for Tesla, or recall. I always put that in quotes because it's an over, the air software update. But again, tied to autonomous driving. So I think there are bigger questions here. Yes, there's stuff that's specific to Cruise, but it feels like we're at a moment where there's some bigger questions about where we are with true autonomous driving.
Yeah, and remember too, GM execs did say just a few weeks ago when they reported some color about this, they did say, listen, we expect kind of the pace of Cruise's expansion is going to be more deliberate. They noted, listen, we understand trust has to be kind of rebuilt here at this point with regulators after these incidents, and they said to expect substantially lower spending at Cruise. So they kind of laid it out there for you.
They did lay it out, although it's interesting that the stock is seeing such an upside today, even after they gave some hints that this is going to be happening.
Yep.
Yeah.
And finally, let's turn to Schwab here. Shares of Schwab rising today. It's after the bank reported a rise in core net new assets. So that was the news here, Julie, that these the core net new assets for November, 21.7 billion. So that was a pretty big jump month over month. It has not been a great year if you're long the name. It's down about 15% in 2023. Though we should know, many of the analysts see better days ahead. You got about 20 buys on the stock.
Yeah, so the story for Schwab this year was that it was caught up in the regional banking crisis. There were concerns about deposit outflows from the company. So this latest month showing that there's some reassurance on that front with those net new assets climbing by the pace that they did. And at the same time that we were hearing this from Schwab, just wanted to mention a broader milestone as well, which is that if you look at regional banks, and Schwab is not a regional bank per se, but was caught up in that whole thing, we are seeing regional banks come back to the level where they were before the collapse of SVB. We're looking at a couple of the different indices there of those regional banks, and we've recovered the losses now that were incurred in the April-May timeframe. So it's interesting that Schwab is making this announcement today at the same time that's happening, sort of emblematic of
to your point, you're absolutely, the regional banks, look at some of those ETFs, they've popped like 20% in 4 weeks. It's a big jump.
Yeah, well, the whole narrative with rates, I guess, hasn't hurt, although lower rates is sort of a double-edged sword when it comes to the banks.
We've got just the man to talk to coming up on the show later, I believe, about
the
banks.
We do. We're going to talk to Gerard Cassidy, and we're going to continue to
count
down some of the biggest stories of the year. Hopefully I didn't give too much away. We're just getting started here on Yahoo Finance Live. Coming up, the Dow looking to extend its record run after the Fed voted to hold rates steady. We'll tell you what it means for your portfolio. And many millennials say investing is the, quote, grown-up thing to do. But does Gen Z agree? And are they actually doing it? We're going to break down the results of a new survey. Also, earnings after the bell will bring you Costco's first quarter results and most importantly, tell you if the $1.50 hot dog soda price will rise. Come on, it's not going to rise. There's no suspense on that one. There is suspense on how the numbers are going to be. We'll have much more when Yahoo Finance comes back.
The Dow looking to extend its record run after the Fed voted to hold rates steady in its last meeting of the year. Central bank also putting multiple rate cuts on the table for 2024. The Dow closing above 37,000 for the first time ever after that news, now about 1/3% here. For more on this, we're going to turn to Mike Aroni, State Street Global Advisors U.S. Spider Business Chief Investment Strategist. So, Mike, you were listening to that Fed presser yesterday like the two of us were. At least initially, investors, they really loved what they heard, Mike. You saw that euphoria take hold, rallies in the stock and bond markets. Give us your take, Mike. What did you make of what the Fed did and said yesterday?
So I think from my perspective, as long as the soft landing outcome, the promise of that, if that becomes the reality, I think that markets seem to be embracing that, rallying significantly, and perhaps most importantly, broadening out. So to me, the big surprise yesterday, Josh, was probably the notion that the Fed will be cutting rates next year and, kind of even to a greater degree than anticipated. So that's the one area where I still have my antenna up because I'm a little concerned if they're cutting rates, it likely means that the economy perhaps is slowing more than anticipated. So that's the one kind of area, but it was much more dovish than I would have thought headed into that meeting.
Much more dovish to the point that now the market is pricing in more cuts. I mean, it's been pricing in more cuts than the Fed is implying, but it continues to do that here. So how much room for disappointment is there, not just around the number and pace of cuts, but to your point around why they would have to cut if the economy is worsening?
It is unsettling, Julie, from my perspective. And that is, I think the market should be kind of hoping for higher for longer. I think this notion that they'll be cutting rates, aggressively cutting rates, if that is the scenario, I think it suggests that the economy is slowing worse than anticipated, or there might be a capital market catastrophe somewhere. And those are two bad options for risk taking. So I think this is a be careful what you wish for moment for markets. So I would much rather the kind of promise of the soft landing scenario become the reality than the fact that the Fed is forced to cut rates to a greater degree than the market's anticipating. It's hard for me to envision this notion that inflation comes closer to the Fed target, that the economy just gently lands on the runway and we all go on our merry way as they cut rates. I just think that the risks are really skewed to the downside on that scenario.
And Mike, as you noted, you were surprised by that pivot that you heard there. I think a lot of people were. Did that change, Mike, then, as you were listening to that? Did that change, where you see opportunity in the equity markets and kind of just the near intermediate term here?
It hasn't changed it much. And we chatted about this the last time I was on. What's been fascinating is the impact that interest rate volatility has had in terms of on the market's returns, in terms of the stock market. And sure enough, here we're seeing that again as 10-year treasury yields are plummeting. Real estate stocks, bond proxies are leadership. Financials are doing well. So you are seeing that broadening. Small caps are doing well, which is kind of consistent with the historical precedents that ultimately as interest rates fall, perhaps we get some normalization, some stability here in terms of the future path of monetary policy. You do see value stocks and small cap stocks rally. And sure enough, as this has been happening, Russell 1000 value has been beating Russell 1000 growth, and small cap stocks have been leadership. So it hasn't changed much of my thinking going forward.
Yeah, I'm really struck today by the outperformance of the Russell 2000 and just the huge gap. It's up 2.5%. compared with the S&P up 0.25%. So it's a big difference here today, Mike. What are you recommending in terms of strategy then? Do you go value, go small caps, and that's where you should be positioned kind of heading into 2024?
I think that's right. And again, I think this is really holding on tightly to this notion that the soft landing outcome is achieved. And again, I can't stress enough that a soft landing is a unicorn. It's rare. It has only happened a few times in the last, 50, 60 years. So again, this idea that we just kind of the economy slows a little bit as inflation comes in and the Fed has to cut rates in response to that gently. I do think that the risks are skewed to the downside, but the data suggests that that's the case. Retail sales, productivity gains, the job market, all of the data suggests we're trending towards that soft landing. So as a result, Julie, I think you're in quality growth and cyclicals, energy, financials, materials, technology, small cap stocks. They will all benefit in that soft landing outcome.
And Mike, when you say quality growth, what defines quality growth? What's the criteria that sort of defines that? And what are the ETFs if you want to play that theme?
Sure, Josh, I think you've kind of hit the nail on the head here, and that quality is in the eye of the beholder. So the way I think about it is stable earnings, healthy balance sheets, low debt to equity. They can self-fund, meaning they don't have to tap into the financing markets at higher rates now. Maybe they're paying or growing some dividends. So the kind of S&P Dividend Aristocrats Index, for example, is one of these kind of areas that we think fits that mold. The NYSE kind of technology leading index also is another area of quality growth. So XNTK, SDY, these are areas in our view that represent quality and in many instances some component of growth as well.
And what role do bonds play in all of this?
So it's interesting in that the fact that income has become more plentiful hasn't made the bond decisions any easier. So, I mean, bonds still play an important role in a diversified portfolio. And certainly as yields fall, those longer duration maturities have benefited. Most investors that we kind of work with seem to be barbelled. So they tend to have a lot on the shorter end of the yield curve, lots of liquidity, stable income, low volatility, very little interest rate risk, very little credit risk. And they're barbelling that with intermediate term positions in terms of intermediate treasuries or intermediate investment grade corporate bonds to kind of create that barbell, that balance between longer and shorter duration fixed income instruments. Now, Julie, the one quick thing I'll say here is that what's going to happen as we go to 2024, and is happening now, is that the threat of reinvestment risk is becoming the reality of reinvestment risk. And what I mean by that is as yields fall and investors' short maturity in fixed income investments mature, folks are now going to have to invest at lower rates. They're going to have to deal with that. And ultimately, they're tending to find more opportunities in traditional fixed income markets and maybe to an extent credit. So that also will continue, I think, as we head to 2024.
Interesting stuff as always, Mike. Good to catch up with you, Michael Roney. Appreciate it.
Thanks, Julie.
Shares of Moderna popping today on positive trial data for a skin cancer treatment. Moderna developing the vaccine alongside Merck, but those shares little changed today. Here with more is Yahoo Finance's Anjali Kamlani. Anj.
Hi, Julie. Well, yeah, so of course, Moderna out with this update on its cancer vaccine that it is testing in tandem with Merck's Keytruda, that blockbuster cancer drug. And what they found is that the drug in tandem with the vaccine can reduce the risk of recurrence of melanoma, late-stage melanoma, by up to 49% after 3 years. That's a really huge number in terms of the protection that it can give patients. So that's where the jump is coming from today. Moderna finally getting a little bit of positive news for its stock. We know that it's been a little bit under pressure because of the lack of movement in its pipeline ever since the one vaccine that they do have to their name, which is the COVID-19 vaccine. So I had a chance to catch up with the CEO earlier today, and we were talking about that and the leadership changes that the company has been through as well, and how he is now going to be looking over commercial progress, and he wants to, in his words, obsess over it. So looks like Moderna is in for some hard times ahead.
Yeah, and Angela, I want to switch names to another name here. Checking out Pfizer today under some pressure. It's down more than 2%. Looks like that's off this 2024 outlook. What's new there?
That's right. First of all, I just want to point out, I never thought I'd have to say these two companies' names in the same breath again since COVID, but here we are again. So Pfizer.
Well, because they're both facing some similar challenges of moving past that era.
Absolutely,
Yeah.
and that is where the pressure on Pfizer comes from, downgrading its 2024 outlook to be basically flat compared to 2023, and saying that its COVID portfolio is estimated to bring in just $8 billion. That's a lot less than what the street was looking for and estimating. But in the call yesterday, Pfizer CEO Albert Bourla, as well as CFO Dave Denton, did have to battle a lot of really sort of stern questions from from analysts, a lot of doubt and a lot of wariness that has been sort of an overhang on the stock for years. Even during the pandemic, we had conversations here at Yahoo Finance with Albert Bourla about just that, about how their stock didn't get that boost that a lot of others saw during the pandemic. And he said, even earlier this year in April, saying, quote, "Although I'm not happy, all we can do is to execute on our strategy so that investors will see that this is a good growth opportunity." And that growth opportunity he's referring to is the 2 acquisitions last year, as well as that huge $43 billion Seagen, which is oncology focused this year, as well as getting 13 launches of new products from the pipeline. So a lot of R&D focus for the company, and still not being rewarded there by the street. Lots of doubts, including, for example, in an analyst note from JPM saying PFE shares are looking increasingly washed out at current levels. We do not see a clear path for the stock to recover, given the ongoing uncertainty about the company's core earnings power. And basically what they're saying, and what these analysts have been saying, is that even though they have these acquisitions and they have this rich pipeline, there's nothing to really make up for what could be a $17 billion hole from patent expiry at the end of the decade. And so there's no catalyst, there's no blockbuster to take place what they're losing. And even though there's a lot in the pipeline, there's nothing that's really standout and enough to really just weigh on, give up the weight on the stock.
All right, we'll keep watching. Anjali, thank you so much for that. And moving on here, coming up, we're going to dig into a new survey revealing the investing behaviors of millennials and Gen Z. Which generation takes a YOLO approach? Find out after the break. Stocks are off their highs of the day, and there could be some signs the market is overbought. Jared Blickery is here with a closer look. Jared.
Josh, that's all I got. I've been looking for signs of bearishness throughout the market because that's what I like to do. I'm a contrarian. I look for weakness when we're having strength, and there's just not a lot of weakness to be found in the market, but I will show you the S&P 500 here. In addition to being overbought, it's about a 77 on the RSI, over 70 is overbought. We have a little doji candle here, and if you're reading Twitter or X nowadays, bears think that's the key to a reversal. Now, I have to say, this can lead a reversal. You have to take it into context with the following day, but I thought it'd be useful to just kind of review some of the incredible moves that we've seen here. Here's a 10-year T-note yield. This is a 2-month drop from 5% all the way down to 3.93%. People were pegging this as a move that would happen over months into next year. That happened in a matter of 2 months here. Taking a look at the US dollar. Julie, you were mentioning small cap outperformance earlier today. A lot of that has to do with the dollar heading south, and that makes it easier for a lot of these companies not to do business internationally. That's the excuse for multinationals. But this is a sign that the interest rate environment is favoring cyclical companies once again, and a lot of these smaller companies fall into that category. They're not financially levered. They have to deal with the economy as it comes with the rest of us. So US dollar down 2 big moves over 2 days there. And let me show you what's been happening in the month of December here. This is the last 10 days. We got 10 days out of 21 in the month of December. Real estate, that is an interest rate play. Mortgage rates finally south of 7%, I believe again. Well, real estate benefiting, that's up 8.6%. XLY is consumer discretionary. That is a retail. Consumer discretionary is a retail-oriented stock. We are in the month of December. Then you have industrials, financials, materials, utilities. Those are the outperformers here. And who are the underperformers? Energy. That's been kind of a sore spot for a lot of parts of the year. Crude oil down about 8-10 weeks now. Staples is defensive, so not concerning that that is not popping here. And you see tech is underperforming. It's still up 3%, but if I show you a chart of the Nasdaq or a heat map of the Nasdaq 10 days into the month, this is a market departure from what we were seeing only a few months ago, where you saw this half of the board. That's the mega caps. That was all green, and most of this was red. So the broadening of the rally is really a thing here. And if I take a look at the leaders over the last 2 days, taking into consideration what happened yesterday after the Federal Reserve, take a look at the top line. We have solar energy, that's TAN ETF. That's up almost 15%. Regional banks up 11%. Josh Schaefer pointing out that the gap has been filled in certain banking indices, regional banking indices. So a lot of the panic from March has been reclaimed here. Take a look at home builders, up 8.4%. That ties into the mortgage rate thesis. ARK Invest, that is the disruption trade. Oil, small caps, retail, IPO, the list goes on here. So difficult to find any bearish indicators in the market. I've just been filling out the day trying to review the bullish ones, guys.
Jared, what's that IGV way down on the bottom that's in the red?
You know, I'm glad you mentioned that. That is software. Let's take a look at software here over the last 2 days. Adobe, that's an earnings story, down 7.7%. ServiceNow, Microsoft, the Kahuna, that's down 2%. If I show you an equal weighted view here, you can see really only the bottom row, maybe part of the second, but for the most part, even software is bumping here. Microsoft market cap is weighing down the entire sector.
Gotcha. Jared, thanks a lot. Appreciate it. Well, as we approach the new year, many people are rethinking their investment portfolios, particularly in light of easing inflation. As the Fed indicates, multiple rate cuts are on the table for 2024. 2023 has been tough on investors, coping with high interest rates and talks of recession, although ultimately stocks have gone up. In fact, though, a new Bank of America survey reveals 85% of young adults adapted their investment strategies due to the economic climate of the past year. For more on that survey, we turn to Aaron Levine, Bank of America President of Preferred Banking. And this is a certain level of income, young adults, right? Folks who have some money to put in the market. Aaron, what strikes me about that figure is how many of them might have missed out if they adapted their investment strategies. In other words, because the rhetoric has been so negative this year, if they adapted at the beginning of the year because they thought things were going to be terrible, I don't know, maybe they missed out.
Yeah, well, first, thanks for having me on. But remember, if you look at the survey, you had a pretty interesting divergence. About 45% adapted a more conservative strategy, and about 41% adapted a little more of a aggressive strategy. So like always, it makes a market, right? You had both sides of that. But I think the most important thing is the participation, right? Across these two, generational groups, younger generations, they're very active. They're participating in the market. They want to invest. And that's great in terms of long-term, their participation.
And Aaron, when we say they're participating, how and what are they investing in, Aaron? Are they going to financial advisors and buying mutual funds? Are they buying stocks, Bitcoin? Yeah. Do we have any sort of insight into what they're actually investing in?
We do, great. So about 40% are doing it online themselves. So go into a place like Merrill Edge or one of the online brokerages. About 24% are using digital advice, so managed portfolios that you can do, quote unquote robo-advisor, and then about 20% are using advisors. I think that 20% is probably towards the upper age group of the millennials, right? So that 30s to 40s, where the younger cohort is more doing it themselves online. But within that, yeah, they're doing a combination of things. They're certainly buying some individual stocks, but at the same time, they're also investing in more funds and ETFs.
And Aaron, what are some of the biggest investment philosophy decisions or differences, I should say, between Gen Z and millennials?
Yeah, I guess not surprising. We think, again, Gen Z, 18 to 26, there's a lot of let's get rich quick stuff. So probably a little more individual stock buying, a little more risk taking, a little more I'm trying to do something fast. Whereas the millennials are thinking more long term, which is terrific. Probably 10 years ago, they might have had a different philosophy. But right now, they're thinking retirement. They're thinking long term investing. And so that's kind of an age thing. And I wouldn't be surprised if that Gen Z cohort 5-10 years from now starts doing the same thing.
I mean, how much of that, though, is sort of TikTok driven or social media driven for Gen Z, that there is that philosophy out there that you can get wealthy quickly in the market?
It's certainly there. Actually, one of the things I was surprised about with this survey was over 50%, it was 52% said that they don't believe social media is a good place to get financial advice. And that was pretty encouraging. And I bet you that would have been a lower number a few years ago. So I do think that while social media, TikTok has big influence, there's no question other sources, more reliable sources, are becoming more and more used, certainly by the millennials, and hopefully Gen Z will do the same.
And Aaron, in terms of the demographics of the people you're surveying, any more color there? How much are they earning, for example?
Yeah, so sure. For the millennials, so it's really folks that have about 50,000 to $1 million in investable assets. 100,000 to $1 million, and then Gen Z, we went 50,000 to $1 million. So these are all certainly young professionals who have good earnings power and investable assets that we're talking about, which is, again, these are the folks that they're in the market, they're active, but they are clearly, and what you're seeing is with the labor market pretty strong, these are all individuals that have good, solid paying jobs, and they've saved some money, and they're now actively investing.
Aaron Levine, thanks so much for bringing us the results of the survey. Appreciate it.
All right, thanks for having me.
Well, there's good news for home buyers. Mortgage rates falling below 7% this week for the first time since August. The 30-year fixed sits at 6.95%. Just like we've been seeing in the broader Treasury market, the momentum has been to the downside here. I believe, 7 straight weeks that we've now seen this figure go down. So that's good news for people who want to buy a house.
Yeah, I mean, in terms of the drop here, I mean, listen, we use different sources. I go to Mortgage News Daily. They actually have the 30-year fixed at 6.62%. So listen, if you look at that number, Julie, you would still say that's a lot higher than many folks are still probably used to seeing. There's a lot of people watching this right now, probably locked in at 3%. I'm guessing they love this segment. I know I would. I
don't know what you're talking about, Josh.
No, I know. It's crazy to you. You have no clue. But it is certainly better than what we were saddled with not too long ago, right? 8%. So it's moving in the right direction for a lot of folks. And you can, you can expect mortgage applications to pick up off that headline. And now I guess the question becomes, where do you think you head from here? Like next year, do you think you head back to 5%? Do you below?
Well, I look at the commentary from Freddie Mac's chief economist that accompanied this, the headline here. And what he pointed out is we likely will see a gradual thawing of the housing market in the new year. The word I fixate on there is gradual, right? We are not expecting to see, even with a come down in rates, that things are going to just flip on
because there's no inventory.
There's no inventory because rates are so high that people don't want to pay those rates. So, and what we've talked to different guests about is what's that tipping point? What's the line? Is it 5%? Is it lower than that?
What's the line where someone who's locked in at 3% says, you know what?
Okay,
I'm
fine,
ready.
I'll do it. Yeah.
And then if that hits that, is there just a flood on the market? And what does that do to prices?
Yeah, we don't know what the answers to any of
You know,
these
it's not a
questions
problem
yet.
you're worried about. I don't think it's not a concern.
I'm worried. I'm
worried.
sympathetically worried for
That's nice. That's nice.
other people and for the economy as a whole.
Maybe
How's
for your
that?
co-host. How about that?
Exactly, and for you. I didn't know if we wanted to make that personal.
Why not?
I hope
Put it out
I
there.
hope rates come down for you. Coming up, e-commerce giant Etsy laying off 11% of its staff. We'll dig into the company's plans for restructuring and whether you might want to buy the stock here. That's after the break.
E-commerce giant Etsy announcing it's laying off 11% of its staff. The cuts coming as CEO Josh Silverman says expenses are going up, but the company's sellers are not bringing in more sales. Etsy trying to stay agile as they restructure and focus on key growth areas. For more on the state of Etsy, we're going to turn to BTIG Director Marvin Fong. Marvin, it's great to see you. So the news here is a restructuring. They're going to eliminate 11%. It's about 225 employees. Just get your take, Marvin, on this news. And also, you know, as an analyst who covers the name, were you surprised by it, Marvin?
Not too surprised. I think, thanks for having me on, by the way. But no, I think if you kind of look at, first of all, we've been hearing about layoffs from other tech companies. Spotify comes to mind. But even if you go back to this time last year, you know, we were actually at the peak of tech layoffs. You look at December and January 2022, that was, you know, record numbers of tech layoffs. And actually Etsy was actually still onboarding some headcount because at that time they were saying, We grew so much during COVID. We're just trying to catch up on the hiring. As 2023 has evolved, it has been a challenging year for Etsy, and now they're kind of realizing, with growth kind of challenged, we do have to kind of right size the workforce. So they're kind of actually lagging a bit, kind of the trends. So they weren't laying off this time last year. And now is kind of the time to right size the workforce. So don't really see it as anything alarming per se. It's always good to be more agile, be more efficient. And this will allow them to sort of reprioritize and, kind of run the business with a little quicker time to market.
Marvin, why haven't gross merchandise sales been better for Etsy? What's not working at Etsy right now on the demand side?
Yeah, so great question. Etsy will tell you, if you go back and compare us to our benchmarks, 2019 levels, we have grown a lot more than just about any other competitor, especially if you kind of look at it vertical by vertical. So, home goods is their top category. They've grown, over 3x or almost 3x by that measure. Wayfair, Beyond, which now owns Bed Bath, they haven't grown nearly as much. In clothing, kind of the same story for Etsy. So they had a lot of growth, but all that was sort of concentrated in 2020 and 2021, and 2022 and 2023 have really been sort of digestion years. They pulled forward so much demand that they have been finding it hard. And the other thing I think is that, Etsy is kind of your classic, very discretionary purchase. They're not selling things like Amazon. They don't sell diapers or, things of that nature that are, everyday consumables. They're quite a bit on the discretionary end. And so, that's also something where the consumer, especially for much of 2023, they were under so much pressure, necessities cost so much, and eating up so much of consumer budgets that it was sort of that very discretionary item that has been the most challenged. So a couple of different factors working against Etsy. They've been doing their best to sort of counteract that with lots of other strategic initiatives, but it's all kind of washed out to fairly flat growth.
And Marvin, so we talked about some challenges, the macro, the consumer. What about competition as well, Marvin? And not just Amazon, but Temu, Shein. I mean, both of them seeing rapid growth. What does that mean for Etsy and how are they navigating that dynamic?
Yeah, it comes up a lot in our most recent conversations. It's kind of hard to quantify. I mean, we know that Temu is garnering a lot of market share. They really do kind of compete more head to head with Amazon. They're competing along, hard goods, soft goods, things of that nature. And really low end stuff, right? We kind of know that the quality is, can be pretty suspect. On Etsy, the typical shopper is looking for something very personalized or very special, very handmade, something that will stand out and be kind of unique. So they're not really going to find that with Temu or on Temu, but we do know that, hey, some person out there is going to say, I can't resist this. This thing is, a fifth of the price that anywhere else. And that potentially that shopper that might be, potential Etsy customer is going to wind up buying on Temu. Our research shows when we look at the web traffic statistics that the overlap, that the percentage of people that visit Etsy and visit Temu on the same day or Shein on the same day, it's pretty low. It's 15-20% kind of overlap. That overlap is much higher between Temu and Shein versus Amazon, as you might expect. But that ratio is growing. So that overlap with Etsy is growing because Temu just has so many more customers. But right now, we think it's not the number one headwind to Etsy's growth, but it's certainly entering the top 5 or 10 reasons why Etsy kind of maybe seeing some headwinds to its growth.
Marvin, all this said, you've got a buy rating on the stock. Why? And the buy rating doesn't do you much good if everybody doesn't believe it's a buy. In other words, what's going to convince the rest of the street to turn around on this thing?
Yeah, I mean, our view has been, so starting several months ago, we actually did a very deep dive into the business. We calculated a number of metrics that the company doesn't report itself, things like churn, LTV to CAC, which is sort of the return on investment that they on their ad spend. We looked at the reactivation rate, which is really important for the company because they have over 100 million buyers that used to buy on the platform, but haven't bought in the last 12 months, so they're considered inactive. And when they reactivate, they come back on board. And these are, some of the metrics that we analyzed, and we really found that the main problem is order frequency, which you can kind of imagine. But things that aren't problems are things that I just mentioned, like churn was not a problem. The reactivation rate is hanging in there. So when we look at why growth has been challenged, that order frequency is a problem we see on lots of other platforms, like the ones I just named. The ones that we actually have the disclosure that we can calculate it. So we looked at, like a Wayfair discloses order frequency, and we see that Etsy is comparable to that type of decline in order frequency. So we don't think it's a Etsy specific problem. We actually think it's across most of the KPIs that we looked at, the key performance indicators, we felt that they were actually reasonably healthy. As far as the stock, the stock is actually, we liked it because the valuation was getting pretty extreme. When it was, it started November south of $60 a share. We thought that this is still a good business. The margins are very strong. They're churning out cash. The free cash flow yield was topping 7-8%. At a time, that's a better yield than you were even getting at the 10-year when it was at 5%, right? So we thought that you got a very solid business, a well-run business, a household name, having a bit of a rough patch, but the valuation was really there. And as you can sort of see now, you just saw on the screen that it has climbed back up closer to our current price target.
All right, Marvin, thanks so much for your insight on Etsy. Appreciate it.
Of course. Thank you for having me.
Coming up, the closing bell on Wall Street. We're going to check in on the latest market moves and the top trending tickers. Stay tuned. We are moments away from the closing bell on Wall Street, so let's check out some of the action in today's session. It's been such an interesting day, and I know Jared was looking a lot at the two-day action before, because of course this is when we heard from the Fed yesterday, and then just up and away. The Dow looks like it's going to close at another record in today's session, but elsewhere we've seen a little bit of a loss in momentum, notably in the Nasdaq, in the S&P 500, and in particular the Nasdaq 100, which, Josh, was flirting with record close.
Well, yesterday, so you saw the euphoria, right? Parties on, everybody rally, stocks, bonds. Today, losing maybe a little bit of steam here. And some of the guests we were talking to showing some little caution.
Yeah, definitely showing a little caution, and saying maybe things got a little ahead of themselves. So I guess that's reflected in what's going on here. So all the major averages here showing some modest gains, certainly on the 2-day level, but also on the 1-day. All of them recovering by day's end after sort of flirting with negative territory at different points during the day. The S&P 500 still closing at its highest since January 12th of 2022. Nasdaq also at its highest since 2022. Really interesting movement in small caps today for the Russell 2000. It's only its highest since July, but it had its biggest 2-day gain going back to November of last year. And the gap between small caps and large caps today, I think, was pretty notable in terms of the performance. The Russell up 2.6% versus those more sort of anemic gains that we saw in the major averages. There you see the gap between the S&P and the Russell specifically. The Nasdaq 100 finishing the day lower, as we just mentioned, snapping a 5-day winning streak. But elsewhere, there's a lot of streaks. Jared Blickery was just messaging us about all the streaks. The Dow, the Nasdaq, and the S&P up for 6 sessions straight. The XOY, which is consumer discretionary, up for 8 days straight. Industrials up 7 days straight. We had some snapping of winning streaks. The XLK Tech snapping its winning streak, as did healthcare. So a little bit of divergence and not so much the everything rally that we had late yesterday after the Fed.
We'll keep watching. Meanwhile, let's get to some trending tickers of the day. First up, have a look at Rivian, the electric vehicle maker, jumping after striking a deal with AT&T as the telecom giant tries to make its fleet more green in a new pilot program. So that's the headline here that moved the stock. Rivian saying it's going to supply EVs for AT&T's fleet. Stock pops. Apparently, first vehicles, Julie, arriving early next year. Remember, at November, Rivian told us it ended that exclusivity deal to supply EVs to Amazon. So, and by the way, you saw green today, not just for Rivian, but other EV makers caught a bit as well. Tesla, for example. And Rivian now up about 20% this year. Remember, we spoke to Stifel's Stephen Gengaro on the show. He kind of recently initiated Rivian as a buy. And his target was 23. Part of his thesis, I remember, was yes, they had this agreement with Amazon for 100,000 vehicles. But he also thought, listen, there are other commercial opportunities as well. That was part of the reasoning why he was telling his clients this one's a buy. So maybe that's starting to play out here. But
I mean, you've got the fundamental case on Rivian, and then you have sort of the momentum, frothy, technicals, whatever you want to call it, that goes on underlying Rivian. And while, as we just pointed out, it wasn't an everything rally today, it wasn't risk on universally, you did see pockets of these stocks that have tended to move on speculation as much as fundamentals also move on the day. So just wanted to point out that. Also wanted to point out that 13% of this company's float is shorted, according to Bloomberg data. So, you maybe get a little bit of a short squeeze situation.
Not unexpected.
Exactly, when that goes on. Let's talk about Live Nation as well. That stock is rising on an upgrade from Morgan Stanley. It's now an overweight. Price target $110, and the analyst behind the call says the fundamentals behind music and live events are some of the healthiest the entertainment sector has seen as we head into the new year. The shares are trading higher by about 6%. Most of the analysts who cover this are bullish. There is one sell, but 17 of the analysts who cover it have rated a buy here. Basically, the analyst there is talking about what we've seen in music and live events. We have seen it all year, what's been going on in the event space. Also, there was a little bit of positive news for Live Nation yesterday that I quickly wanted to mention, and that's one of the 2 class action lawsuits that had been filed by a Taylor Swift fan against the company related to the whole Ticketmaster getting tickets situation. It was dropped. We don't know if there was a settlement in that case, but that was something potentially that was positive for Live Nation as well.
Yeah. Stock now up about 30% this year. And Morgan Stanley is not alone, by the way. As you mentioned, Julie, lots of love on Wall Street for this name. And more than 80% of the analysts paid to give you the recommendations do say this one's a buy.
Yeah, I mean, there are still some sort of investigations out there into the ticketing practices. According to the New York Times, the Department of Justice is looking into it. The Senate is looking into ticketing practices as well. Remember, everybody wanted Taylor Swift tickets. Not everybody could get Taylor Swift tickets. There were a lot of different explanations for why, beyond just the normal demand and supply situation. And so we'll see if that ends up having any kind of effect eventually on Live Nation, but not for now.
All right, one to watch. And moving on, finally here, Weight Watchers, WW International, formerly known as Weight Watchers. Stock is up today after it launches a program for individuals using GLP-1 medications to lose weight, a topic that has taken news headlines by storm, of course, throughout this year. So that was the headline. News that they're going to launch this new plan, the Weight Watchers GLP-1 program, Julie, apparently $99 per month. And I guess from what I was reading, it's sort of designed and tailored for those, if you're on these new medicines, it's going to give you kind of tips, support, nutrition. I guess the idea is, listen, if you're on these drugs, maybe you kind of need a different regimen than those who don't.
That kind of makes sense, right? Given the reportedly big changes in appetite that people have when they are on these things. Coincidentally, this also comes as Oprah Winfrey has publicly said that indeed she is taking a weight loss drug herself. You know, Oprah has had a very public struggle with weight her entire really professional life that she has talked a lot about, and she happens to be on the board of WW International. So it's interesting, these things happening at once and the stock reacting.
Yeah, it's interesting too with GLP-1s because we've talked about so much, listen, investors trying to place their bets and figure out who, not in the near term, but in the long term could maybe potentially be in the crosshairs, and you would hear restaurants and packaged foods, but you would also hear about Weight Watchers, right? So maybe this is also trying to get ahead of that trend a bit as well.
That's true of the other sort of weight loss services as well, and some of them have kind of said, no, we're not going to go that route, and then changed their minds. So we'll see what happens overall with the weight loss industry. Well, shares of real estate investment trusts, also known as REITs, they are showing some optimism after the Fed signaled 3 rate cuts in 2024. Joining us now is John Worth, NAREIT economist and head of investor outreach. Am I saying NAREIT? That is how I say it, right?
Perfect.
Yes. Okay. The National Association of Real Estate Investment Trusts, to put it another way. And indeed, it's been remarkable with the move down in yields. We have seen real estate stocks kind of go crazy here. Is that justified? Are you hearing a lot of optimism in the industry?
Yeah, absolutely. And part of our year-end outlook for 2024, and Christmas has sort of come early for us, was that with a normalization of the monetary policy cycle, we'd see REITs outperform. Historically, that's what you see. When you get to the end of the rate rising cycle, REITs are going to outperform over the next 12 months. This has actually been, we've seen quite a bit over the last 2 days, but this has actually really been going back to the beginning of November. If you go from the beginning of November through midday today, REITs are up about 22%, putting them in positive territory for the year. They're up about 12% for the year. And some of the sectors have really changed direction over the last basically 40 days plus.
And John, when you look ahead then in 2024, which are the property sectors you would expect to really keep performing? I mean, is it data center or logistics facilities, hotels?
I think there's definitely very clear trends and lots of tailwinds behind all the digital sectors. So cell phone towers, data centers, industrial and logistics properties, those have been very strong performers. One of the things we've actually seen pop over the last couple of days, if you go back to the beginning of November, offices are up 40%. So the other thing that we think is going to happen is we're going to see some of the office REITs, which are just about 5% of the market capitalization, but we're going to see the quality of their portfolios start to show through as we see analysts maybe stop painting all office with the same brush and recognize there's quality office and not such quality office. And REITs, for the most part, have the quality office.
One of the things we were talking about earlier in the show is residential mortgage rates coming down. And at what level you see the tipping point where demand really starts to loosen up? What's happening on the commercial side, right? What's happening in terms of sort of a freeze in the real estate market, and how low do rates need to go to unfreeze?
Yeah, I think that's a great question, because the freeze is both in terms of some owners having difficulty getting bank lending. REITs, luckily, do most of their lending in the unsecured markets, and so capital markets have been open for REITs. They came in as
at a price, I imagine.
At higher prices, but because they came in with low leverage, mostly fixed rate debt, and a lengthy term structure. So today the weighted average term to maturity is about 6.5 years. They've been able to be a little selective in when they go to market and when they do refinancings. But the real holdup that we've seen has been this lack of transactions. And I think that even with the Fed easing, that's going to be easing to a higher rate environment. So I do think in 2024 we'll see that commercial real estate sales market open up, and we'll see some of those prices start to reflect the reality of higher interest rates. And I think there's a good reason for public REITs to be potentially winners in that, because again, they're low leverage. They're coming in with low leverage. They have access to capital through both debt and equity, and so they can potentially be the buyers in those cases.
And John, I know one thing you've talked a lot about is also this kind of relationship between REITs and ESG investing, which maybe isn't a relationship a lot of people immediately think of. Just walk our viewers through that relationship, how you see it.
Yeah, and I think it's important to keep in mind, everything REITs do is really going to be focused on the long term. They're long-term operators, they're long-term owners of real estate, so they need to be long-term thoughtful stewards of that real estate. And so that involves understanding what the risks are from future regulation, as well as a desire to improve the sustainability performance of their structures. So what we've seen over time is that academics who have studied this find that when you compare REITs with sort of private real estate, you're actually going to see better sustainability performance from REITs, which is sometimes surprising to folks. When you understand the structure and the incentives of REITs, again, as long-term holders, they're not buying to flip over properties in the short term. It makes sense that they would also do well in terms of sustainability measures.
I have one more question on the outlook for next year, which is where you see the biggest risk, because certainly the rhetoric surrounding much of real estate, especially office, has been very negative this year. There's been talk about default, et cetera. Does any of that linger next year, or what else should people worry about?
Well, I think for commercial real estate generally, I think that even though the Fed announcement over the last couple of days has been welcome news, it doesn't mean if you're a high leverage owner that you're necessarily out of the woods, because rates are not going to come down to where they were. So I still think rates are going to be a risk, and there's going to be a process through which we get private real estate repriced and we get transactions moving in that market.
All right. John, thank you for coming in today, for that insight. Appreciate it.
My pleasure.
And coming up, we break down cyber risks in the new year and possible impact on the 2024 presidential election. It's coming up after the break.
The Senate will be back in Washington next week as lawmakers try to hammer out a deal on border funding. It comes as the House heads home for the holiday after passing a defense spending bill, as more Democrats voted for the bill than Republicans. Rick Newman's here live, in person, living color, to talk to us about all of this. Hello. So what's happening with Ukraine funding? What's happening with Israel funding? What's the latest as the House breaks and the Senate gets ready to break?
And you have to add border security into that, because it's all mixed together now, because Republicans said we're going to do this all together. So what might be happening is they're actually making some progress, and up till now there's been nothing that looked like progress. It looked like Republicans said we're not going to consider Ukraine and Israel funding until we get the administration, the Biden administration, gets serious about negotiating some changes to the border here. So now maybe what is changing, as at the Biden administration and the Secretary of Homeland Security has been talking to people on Capitol Hill about what kind of changes they might be able to agree to. So, this is how deals come together on Capitol Hill. It still seems unlikely anything's going to happen before the end of the year, because to actually pass a bill so the Senate is now going to stay into next week. They're going to ruin a little bit of their holiday vacation. It's a shame. But the House is gone. So if there were an actual vote, the House would actually have to come back. And this is not so urgent. It's getting there, but it's not so urgent. And this is mainly, we're talking about Ukraine here, which needs that funding. That they have to have that funding in place by the end of the year exactly. But I mean, beginning of 2024, they need that funding, and it's not money we're sending. We're not sending them piles of cash. It's equipment, it's artillery shells and stuff that's in stockpile here that the United States cannot send until Congress says yes, we're going to provide the money for that to go over there. So that's the most crucial thing. And the best case scenario here is maybe this means it's breaking open a little bit, and something will happen at the beginning of 24.
All right, we're going to keep watching. I'm going to switch gears on you now, completely.
Go for it.
All right.
Second gear, third gear, what gear are we in here?
These reports, I want the Rick Newman take on this. Reports that Wall Street now is opening wide the wallet for Nikki Haley. Reportedly, she raised $500,000 at a fundraising event in New York on Monday. My question for Rick Newman is this. Does it matter? I mean, isn't this almost certainly over at this point? It's Trump, right?
No.
He's been leading the whole time. You disagree? You don't think so?
It is not certainly over at this point. And the reason for that is all the turmoil that surrounds Donald Trump.
What is your evidence that Republican primary voters care about that?
There are polls that show that a significant number of voters could change their support for Trump if he gets convicted of a crime. I think that, by and away, is the wild card that everybody's paying attention to here. We still do have at least a couple of these trials scheduled to get started in the first half of 2024. That could slip. We know that some of this is now going to the Supreme Court, but it's going to the Supreme Court on a super fast, expedited basis. And there still is the possibility that these trials are going to get underway, and perhaps at least one of them will be done by the time of the Republican nominating convention over the summer. So this is kind of a bet. I mean, it's a low probability bet, but I think it's a bet that something happens to Trump and he drops out.
Well,
and then number two really matters.
I mean, it's insurance almost, in a way. I mean, if you've got funny money, if you have that much wealth, maybe you want to buy a little insurance.
I suppose. How much are they actually trying to knock Trump out at this point? I mean, I think there's some hopium here. Things, we're going to have 4 primaries are going to tell us for sure which ways this is going to go. Nikki Haley's probably not going to win Iowa, because that's not where she's putting all her effort.
You saw the polls in Iowa. He's a country mile ahead.
He's way ahead. But if Trump underperforms in Iowa, if he falls short of expectations,
that's been the big if, Rick. Yeah, that's been the big if. Right.
Now, I mean, I don't think that if Trump underperforms, Nikki Haley's going to ever be able to close that gap if nothing else happens. But what if Trump underperforms, Nikki Haley gets some momentum, and then there is one of these X factor developments, some new revelation from one of the trials, maybe Trump stresses out, maybe he has a heart attack. I mean, who knows? There are just more wild cards on the Trump side and also on the Biden side because of his age. But there are just more wild cards in this election than.
I mean, Trump is 77.
Yeah, but how people? I think though, without going off the rails, I love rails. Yes, they're both old, but how maybe they read, how people age is a bit different. I think that's what it comes to.
How they read and how they're perceived is one thing, and I agree with you. What actually physically happens to them?
Yeah.
Anything can happen.
You're about this. I just think people age differently. I would say this, Rick. I bet even if Trump, and I would love to keep this bet going, even if that conviction happens, I wonder, do a lot of Republican primary voters actually double down on that?
If what happens? If he
he's
has a heart
convicted.
attack?
If he's convicted.
So here's a real question. If Trump dies, will the Trump voters vote for him anyway? It's possible.
It's completely.
Because nothing
I rule
will
nothing
dissuade
out
them.
in 2024.
If Trump dies, they'll probably say, we don't believe it, fake news. He's alive, and we're going to see him in the White House in 2025. Even if Fox News runs his.
You think it becomes like an Elvis thing?
Yes.
All right.
I mean, nobody knows.
Bernie's.
Nobody knows what will shake the Trump voter at this point.
Yeah. Well, that's one thing. That's the only thing I can count on, actually, is just that. Thank you, Rick.
Okay,
Always love seeing you. All right, also in focus in Washington and across the country next year, the presidential election. And our next guest says that generative AI has the potential to impact the election cycle. It's just one of several key things to watch when it comes to cyber threats. Joining us now is Michael Santoni as CrowdStrike president. Michael, let me get this, just start high level here as we go into 2024. What are the cyber threats, Michael, that we need to be aware of? How are they going to shift and change?
Well, one of the big topics to talk about is the impact of artificial intelligence. There's so much benefit to this technology. It gives us access to information. It gets it at our fingertips, so there's a huge speed advantage. But we also need to understand that those benefits also apply to people that want to do bad things. So we're seeing adversaries get access to information. They're getting smarter. We're seeing the rise in things like dark AI. So we use things like ChatGPT for good. There's equivalents for bad. So we're seeing adversaries create tools to allow the average person to carry out some pretty sophisticated attacks. And then that can flow into so many other parts of our life. We talk about the election. The ease of access to these tools means that you can have rampant spread of disinformation. It's a lot cheaper to do it. And that speed advantage is something that we need to think about from an adversary perspective. It's a real problem.
Michael, I mean, not to get too tinfoil hat then on us, right? But you heard the discussion we were just having with our Rick Newman. When we're talking about these two presidential candidates who are elderly, let's say, and one of them who's the subject of multiple different court battles, right? If something happens, the idea that information could be put out there in a fraudulent, incorrect way. What do you do about that? And how prepared are we as a country and as a globe for that kind of thing?
Well, I'm going to be the bearer of bad news. I mean, that sort of thing happens all the time.
Right.
And we see examples of misinformation all the time. I mean, I'm sure you've both seen that before. You wake up, and whether it's a politician, it's a celebrity, it's an athlete, there's something that they've had an injury, they've retired, sad, horrible stories where people have passed away and they're not true. And obviously, when you think about the context of that in relation to an election, that's obviously very problematic. Look, a lot of work goes into try to lock these systems down. A lot of work goes in to try to get ahead of people manipulating these algorithms or using these algorithms for malicious purpose. And look, we're getting better as an industry. So we see, for example, the early use of generative AI was giving people access to information they shouldn't have. So the average person could work out the formula for how to build a bomb or to get access to information they shouldn't just naturally get. And we've seen a lot of the creators of this software get a lot better to lock that down, to stop that from happening. They can detect when these misinformation campaigns happen and get rid of that. But look, we're early days. I mean, this is the new world that we all live in, and we're going to find out things as we go. We're going to have to get better at getting smarter at how to deal with it. And at CrowdStrike, from our perspective, we try to teach organizations, we try to teach people how to use technology, how to use the benefit, but do it in a safe and secure way.
And how, Michael, turning to CrowdStrike specifically and AI, how are you all leveraging that technology right now to help customers, to help the business?
Well, we've been using it for 10 years now, over 10 years. We pioneered the use of AI in our technology. because we wanted to get the same speed advantage that this technology provides and make it easier for our customers. We know, talking to people around the world, I mean, I'm on the road at the moment, people tell us they want to stop being breached. They tell us they want to reduce the complexity of their cybersecurity tools. They want greater TCO. And that's what we've built at CrowdStrike. So we give them a very lightweight product. It's easy to use, high levels of efficacy using modern techniques like artificial intelligence. And we have a greater opportunity to protect and stop attacks and keep our customers safe and secure. And we've been doing that for over a decade, as I mentioned.
Michael, I quickly want to turn to the new SEC rules that are about to go into effect as of Monday that are going to require more rapid disclosure from companies that have been the subject of cyber attacks and they deem it material to have some sort of, cost for their business. How big of a change is this for corporate America, and are we going to hear about a lot more attacks?
We've been hearing a lot about these sorts of regulations actually around the world. America is no different. There's a number of different regulations that are in place. The SEC is asking organizations to help provide better clarity, consistency, and timeliness with reporting of cyber attacks. But here's the thing. The adversaries, the attackers, the people behind these attacks, they've also jumped on this as well. So they're using that opportunistically. So if they attack an organization, they're trying to hold them to ransom and say, hey, if you don't work with us here, we're actually going to report you to the SEC. And we're actually seeing examples where attackers are compromising organizations. They're doing the reporting for you. So it's an interesting time. A lot of organizations are trying to work out how can they find out fast enough. How can they report to the SEC? How can they get that information out to their shareholders? So a lot of organizations are reaching out to us, navigating the new landscape, the new regulations. They're asking us, how can we help them? And again, it's another example. We get instant visibility. We can tell you what's running inside your environment. We can protect and stop the attack. We can help you understand how to report and how to be more compliant to these new regulations. We do that for companies around the world.
Just very quickly, is 4 days too short a window?
Look, you should be able to see very quickly what's going on, but it is a complex landscape. The bigger you are, the more systems you have, the more operating systems that are constantly being targeted and every day have vulnerabilities. It's hard. I do empathize. It's not an easy thing to do, but better visibility into what is going on inside your environment, it's a good thing.
Michael Sentonas, thanks so much. Really interesting conversation. Appreciate it.
Thank you.
Coming up, we continue our countdown of the top 10 stories of the year. We're going to reveal number 3 right after the break. Stay tuned. We are counting down the top 10 stories of 2023 here at Yahoo Finance. Coming in at number 3, the collapse of the regional banks.
Silicon Valley Bank's collapse is the second largest bank failure in the U.S.
The FDIC took control of Silicon Valley Bank's assets.
It is and should be a matter of concern.
The regional banks, this is over the last 2 days. Some of these moves absolutely astonishing.
Investors will take the fall on this. Officers of the bank will be fired.
JPMorgan Chase stepping in to buy First Republic's assets after the failed regional lender was seized by regulators.
We're reminded about how fragile our banking system could be, and as a result, your banks only got even more powerful.
It was the financial story that shook the markets and the economy, triggering warnings of recession. We've got team coverage of what happened and the impact it's had. Joining us now, Yahoo Finance's David Hollerith and Jennifer Schonberger. David, let's start with you. Just outline for us, remind us what happened.
Yeah, it's tough to say exactly when all this ended and began. But on Thursday, March 9th, Silicon Valley Bank customers attempted to pull $42 billion in what was certainly the fastest bank run in U.S. history. This came after SVB announced it had taken a hit selling some of its bonds, some of its underwater bonds. It was also planning an emergency stock sale in a last-ditch effort to raise more cash. Most of SVB's customers were also startups with deposits at the bank over the insurance limit. So regulators seized SVB that Friday. They seized Signature Bank 2 days later, invoking the so-called systemic risk exception for both lenders, which guaranteed uninsured depositors would be made whole, but was not without its controversy. Though these two banks appeared to be outliers, other regional banks, specifically those with similar business models, faced mounting pressure once investors and depositors began to panic. So after 7 weeks from those two collapses, First Republic failed and was picked up by JPMorgan Chase from the FDIC. The rest of the year was by no means easygoing. Two other tiny rural banks failed. Under higher rates, bank lending also slowed and deposit costs continued rising. But yesterday, we saw, a round trip in which major indexes tracking the regional bank sector officially came back to levels before SVB collapsed. In general, 2023 was still the largest year ever for bank seizures as measured by assets. In total, 5 banks failed and 2 were the second and third largest failures in U.S. history. And it's a slightly different story for what went wrong at each of these banks. But if we just focus on Silicon Valley Bank, the first and second largest failure, the first to happen, the second largest, it came down to mismanagement of risks, both on the interest rate side and on the depositor concentration side. All these banks had high levels of uninsured deposits. They also had some problems that are sort of symptomatic of just what a regional bank has to do because they can't compete with the largest banks. That being said, a lot of this has gone back to what management had done and what they hadn't done during the times of the crisis and before that.
David, thank you for that and for that context, which is now leading to new banking regulation and frustration, we should mention, from the bigger banks. Jennifer, what does the ripple effect now look like?
That it does, Josh. A string of regional bank failures this spring prompted regulators to propose banks beef up their capital buffers to prevent against future failures. The proposal seeks to raise capital requirements by 16%, holding both giant banks and mid-sized institutions to new standards. But banks, as you mentioned, vehemently opposed to this, launching an all-out campaign, including NFL ads. The banks argue that the new rules are just too onerous. Specifically, banks warn that the new capital requirements could make mortgages and loans to small businesses more expensive, while also pushing up consumer prices and the cost of saving for retirement.
If you have the same capital requirements increased by 20% to do the exact same activities you did yesterday, you have to get a higher return, and that higher return will be borne by the customer base.
Even some members of Congress have expressed skepticism, including Democratic Senator Mark Warner, who says the banks may be right and that regulators have told him there are a lot of changes in store to that proposal. Take a listen.
I think they've got an argument. I think that you've got the circumstance where interest rates are at a recent high. The idea of additional capital requirements and additional buffer beyond what's already in place will mean there'll be less capital available for lending.
Regulators have extended a comment period until January, at which point they will accept more feedback, take that into consideration, and put forth a final proposed rule, likely in the spring. One source within one of the big banks tells me that if the proposal is not up to snuff for them, there's a very high chance they could take this to court. Back to you.
All right, Jen Schomburger and David Hollerith, thanks to you both. Appreciate it. So after that tumultuous 2023, what can the banks expect next year? Our next guest thinks they're a good bet for big returns as the Fed slows its tightening cycle and asset quality begins to normalize. Joining us now is Gerard Cassidy, RBC Capital Markets Managing Director. Hey, Gerard, it's always great to see you. Thanks for being here. So as we just heard, we laid out sort of the banking crisis as it happens, the regulations that have in part been born out of reaction to that, although they were already cooking before the banking crisis even happened. So what does this all mean for the banks going forward? They've got this doom and gloom scenario for how much it's going to crimp profit and hurt consumers. What do you think?
I think what we're going to see is that any new regulations that they bring in, higher capital requirements, possibly more liquidity requirements, will certainly lower profitability. We saw that in spades back in the financial crisis. You might recall, following the financial crisis, we saw the Graham-Dodd.
Dodd-Frank.
Thank you. I'm drawing a blank here. Dodd-Frank. Thank you very much. The Dodd-Frank legislation that really increased the amount of capital for the industry and lowered returns measurably. Now, we're not expecting that this time around. Clearly, even though the banks are pushing back, and I think they make some valid arguments, I don't think the new Basel III endgame will be fully implemented the way it's been proposed, and there will be a scaling back of some of the proposals. However, the profitability will probably decline. That all being said, the industry is still, from a stock standpoint, very inexpensive, very cheap, and even with the lower profitability of ROEs, we still see meaningful upside for these stock prices from these levels.
And Gerard, it's been a nice run for some of these names. I'm looking at the KBW, Gerard. It's up nearly 20% in the past 4 weeks. What is driving that, Gerard? Is that rates? Is credit? What's driving that move?
It's a good observation because from the October lows, the banks have really outperformed the market. Year to date, of course, as you've just shown on your screen, they have underperformed the market. But since October, they've really outperformed the market, and it's been driven by a couple of factors. First and foremost, I think what the market is deciphering is that the Federal Reserve, obviously they came out yesterday and pointed this out, excuse me, but the Federal Reserve looks like they're at their terminal rate for Fed funds. And that, in the last 4 tightening cycles, has been the catalyst to get bank stocks to move higher. Second, there's an increasing possibility or probability we're going to have a soft landing in the economy. And if we do that with the terminal rate for Fed funds, this is shaping up to look like 1995 when the stocks were up 55% that year. So those are the two main factors, but also the long end of the curve, the 10-year government treasury in October was up against 5%. There was talk of maybe 6% in the 10-year, and today it broke 4% on the downside. That's been another factor for that move as well.
Gerard, when you look at rates, though, is that on balance a headwind or a tailwind? Rates coming down, that is.
I would say it's a tailwind because if rates come down, the economy is going to be stronger. And we always have to remember in bank stock investing, credit trumps interest rates. And so if rates were to come down and refinancing activity picks up at the long end of the curve, If the Fed, we don't want the Fed cutting too aggressively because that would suggest maybe the economy is weaker than expected. But if you get 1 or 2 Fed fund rate cuts in 2024, the yield curve, starts to come down a bit. That's very positive for the banks because the credit picture really improves. And when you talk to investors today, many long onlys, their number one concern about owning a bank stock going into 24 is the fear of credit problems. And if you start taking that off the table, the stocks are going to work better. So lower rates would be positive in our view because it suggests credit won't be that material of a problem.
And Gerard, one pain point, of course, we talked a lot about in 2023, commercial real estate. Office buildings still not filling up. I'm just interested to get your take on what you see ahead there in 2024 and what kind of risk does that pose to the banks you cover?
It's an interesting question because when you look at the commercial real estate markets, I think it's really a bifurcated market. The downtown office market, where buildings might have vacancies of 30, 40, 50%, those properties are toxic. The owners are defaulting on their debt. The lenders are going to have to foreclose, and you're seeing fire sale prices. Now, that's not the general bank portfolio. Most of those properties thus far have been in the shadow banking industry, meaning the CMBS market. That's who's lending on those properties. What has affected the banks is that the values of fully leased commercial office space around the country, whether it's suburban or maybe downtown, but fully leased space, the value of those properties have declined because rates have gone higher. So if we see a lower rate environment, we could see a stability in those values. And the refinancing of those properties is a lot easier than a property that is 70% vacant. The building's out of, it's 75 years old and needs a major overhaul. Those properties are toxic, and those are going to be written off and written down, no doubt about it. But that's not the main property or exposure any bank really has in their portfolio. So the banks will manage through it. Don't get me wrong, there will be charge-offs, but we think that it'll be very manageable because the exposures, when you look at the risk exposures for all of the big banks, they don't have much exposure to commercial real estate, especially downtown office.
All right, Gerard, I'm going to get you out of here on this. What do I want to own in 2024, Gerard? What's your top pick?
Yep, I would say what we want is risk on. In 2023, the risk off name that was a home run was JP Morgan Chase. We think risk on in 2024 makes sense. Bank of America would be the large cap name, and Fifth Third, Key Corp would be the names to own with the risk on regionals in our view.
Gerard, I always love having you on the show. You always teach me something. So thank you so much for your time.
I appreciate it. Thank you.
And coming up, more Yahoo Finance on the other side of this break.
We're bringing you the latest edition of our series, Lead This Way, where we talk with some of the titans of industry about their biggest challenges and how they're leading through them.
Yahoo Finance executive editor Brian Sozzi recently sat down with former Microsoft CEO and LA Clippers owner Steve Ballmer. Take a listen.
What you want to do is control your controllables. You can control how hard you work. If you're going to get into something, get after it. Yes!
When it comes to business titans, Steve Ballmer is an OG. He was employee number 30 at Microsoft, where he started as Bill Gates' assistant in 1980. By 2000, he was named CEO at the top of the dot-com bubble.
I love this company! Yeah!
His rallying cries at Microsoft product launches became legendary. Ditto his behind-the-scenes hustle and nearly unmatched love for all things Microsoft.
1, 2, 3, go down!
Unfortunately for Ballmer, Microsoft's stock price did not match his energy. He's now a regular fixture on the hardwood as the owner of the LA Clippers, while also pushing for transparency on Capitol Hill through his nonprofit USA Facts. Through it all, Ballmer has led with his trademark energy, conviction, and passion.
Who is Steve Ballmer, the leader today, compared to 20 years ago?
Yeah, I'm involved with three things primarily. People focus in on the basketball team, the LA Clippers, obviously USA Facts. Going to basketball games, I probably spend more time with my wife working on our philanthropy. There's two principles. Principle number one is I've decided I want to be more like an executive chairman than like a CEO in my new life. That means we have people who really run things. That's an adjustment for me as a leader. I'm used to, having my hands on everything. So it was an adjustment. I'm a little more of a micromanager, let's just say it that way. But it's a different style of leadership. You could say you delegate in a big business, but you don't delegate final responsibility. You don't delegate culture. I've delegated those things.
How do you build a successful culture as a leader?
You sort of have to pick the culture you want, and then people who like the culture come and stay, and people who prefer other culture leave. Now, you say you need a diversity of thought, and I believe that, so there's a little bit of a delicate balance, but you need to think, or at least behave. Culture is to some degree what you think, and it's a lot in terms of how you behave. If the kind of culture we want to have here doesn't fit, you should move on. Do we have any Clipper fans here? At the Clippers, tone gets set at the top. We're hardcore. We're going to win. We're about maximizing our chance to win championships.
Steve, is that your best advice to the next generation of leaders, to be hardcore, and work your ass off, and you will find success?
I can't guarantee you'll find success. Whatever success means to you, I think it's a good way to do the ride, but things take, some good ideas, a lot of hard work, some luck. People deny the importance of luck. So in a sense, what you want to do is control your controllables. You can control how hard you work, and you might come up with the right idea, you might not, but you can control how hard you work. Are we getting more safe, better educated, provided for in our old age? I was looking for sources, and then I said, geez, I'd really like to understand the government more broadly by the numbers.
So USA Facts is why you are in D.C. It's why we are in D.C. doing this interview. What are you working on there?
USA Facts is a project I started, maybe 9 years ago. My wife and I were talking about the role of government in serving kids and families that are, sort of in unfortunate circumstances. I said, I'm going to figure out what government really does. And so I set out to see by the numbers who pays taxes, what the money gets spent on, some sense of wealth transfer. We don't try to forecast the future. What we do is we provide data, facts. They're facts because they're about what happened.
You recently met with politicians and key DC lawmakers. What's their response to what you're doing, and what is their view on the data that people ingest right now?
It's not my first time in. We try to do a trip to DC every year. There's generally two reactions. There's some people who say, how do we government do better at presenting our own data to make sure we have the right data?
The bill is passed.
One of the things I'm kind of championing is every time a bill gets passed, there ought to be 3 or 4 numbers that people look at, and they need to come in real time. A lot of government numbers come a year, 2 years late. And there's certainly folks in government who are super interested on how to evolve data, the use of data, the integration of data into process.
These new folks that have joined your team, how do you encourage innovation from them?
I think at least my role in that is to keep asking, are there better ways to do this? Just ask questions, ask questions. Have we thought about this way of using AI? What about this way of using AI? What about visualizations? What can we do better in the kinds of things we do to visualize government data? What are the visualizations that are really going to help people along that path, and how do we continue to push those?
Lastly, what's your leadership legacy?
I'm not big on the word legacy. It's not my thing. If you say outside of my kids and my family and my friendships, what will I feel most proud about? I mean, it's going to be, I was employee 30 at Microsoft and really making Microsoft the company it is. We helped change the world. I have a lot of pride in that.
Shares of Costco trading up about 1% after reporting its first quarter results. So let's dig a little bit into the numbers here. The warehouse store chain announcing earnings per share of $3.58. That is above the $3.41 that analysts had been projecting. Revenue up to $57.8 billion, which was also ahead of where analysts were looking. And importantly, the company has declared a special cash dividend of $15 a share. So that, by the way, that sales number was up about 6.1% year over year. Comp sales, not quite as strong as analysts had been anticipating. If you include gas and currency effects, they were up 3.8%. If you exclude gas and currency effects, they were up 2.6%. Either way you slice that, it was below what analysts had been projecting.
Yeah, and some key questions on the call here. Remember, Walmart said it sees possible deflation in the months ahead. I think analysts want to, does Costco see the same trend? And also membership fees. When do those finally go up? Bulls say, of course, that's an important reason they're in the name. They see that as a key driver. They'll say, listen, that's now long overdue, just judging by historical cadence. And the team at UBS, by the way, thinks that fee increase likely comes next summer, but that's going to be definitely talked about on the call.
Yeah, and you have to wonder, what is the signal that this cash dividend is sending, right? Are they doing this along with an increase in the fees? I don't know. I think that's going to be part of the question.
All right, maybe you'll find out on the call.
Okay, we'll wait for the call then. All right, that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.